Good afternoon. It's a great honor for me to be invited to come here today and talk about Professor Moran's book. Thank you very much, and Fred, thank you very much for the invitation. It's actually felt in doing this, it felt a little bit like kind of coming home. I actually wrote my PhD dissertation on foreign direct investments, so it kind of all comes together. But as you heard, I spent most of my time on the practicalities of business and especially over the last years with IFC. So that's how we will focus the discussion. But let me say that sometimes when you read a book, it's you agree with or you disagree with a lot of things. And being a discussion, you're supposed to disagree. But I had a little bit of a problem because I agree with a lot of the things that has been said. And I think it's really fantastic when you to see that economic research that lends intellectual support to something that you are trying to do on a daily basis. And this is, to me, what this book is all about. I think Professor Moran really does two things very, very well. First of all, he puts challenging questions, as you heard, to everybody, investors, policymakers, NGOs, academics, and the development institutions like the one I represent. And he offers very good practical recommendations to all of us, and I think that's also very helpful. But before I get into it, maybe I don't know how much you know about IFC, I just say a few words about what we do. As you heard, we're part of the World Bank Group, and we are the private sector arm of that. And I guess we're the only global development institution devoted solely only to the private sector. We've been in existence for 50 years. We started out as a project finance house, but have a much wider project range today. Last year we committed about $18 billion, of which about 7 was mobilized other people's money, whether it's sovereign wealth funds or banks, syndications. About 50% of our projects go to IDA countries, that's the poorest countries. And we shifted that rather dramatically over the last couple of years. We provide investment services, which is, as I said, the basics, loan, equity, trade, finance, but also advisory work, and that has become more and more. We are now 3,500 people. We have 103 offices, I think, and we have we're the most decentralized of all the development agencies, with 56% of our staff actually in the field, which is, again, rather. And again, what makes us different, we make money. Last year we made $2 billion because we go in where nobody else dares to go and fixes these market failures Professor Moran talked about. And that allows us, and the good news is that all studies shows that the development impact and the financial sustainability of the financial success goes hand in hand. And if you think about it, a successful company hires more people, worries about the environment, normally had good governance and established benchmarks on those things. So those things, and that's one of the underlying themes for what we do. We look at the investor, or the sectors that you heard Professor Moran talked about. The infrastructure is and natural resources, manufacturing, agriculture, and services, including health and education, as well as financial markets, and of course agribusiness as well. And when it comes to our advisory services, we really now have added value related very much to corporate governance, environmental and social standards, and working also with government on investment climate. You may have seen our report, the Doing Business report. But our own standards is not only the standards for us, they actually are used today by 70 banks around the world. They are used by OPIC and other development institutions here, and as well as in Europe, by the export credit agencies around the world. And we actually have dialogues with the Chinese credit regulators about adapting our standards. So, as you hear, we are doing many other things that Professor Moran discussed. If you look at the foreign direct investments and what's happening there, I think last year marked a very important milestone. For the first time, developing and transition economies attracted more foreign direct investments than high-income economies. And that, of course, reflects the bigger growth potential in the developing countries. I think more than 50% of the growth last year was actually from the developing world. And the large multinational companies know that their future growth will actually come from these markets. And it's not only about the BRICS, even that's very dominant, but also further out in the frontier. And companies are also doing more and more of their research and development. I would say even especially development. In other words, they're starting now to adapt their products to these markets, developing very interesting things. And especially as you start to look not only at the middle class that are emerging in these countries, but also what we call the base of the pyramid. That's the 4 billion people that lives under $3 a day and is a market of $5 trillion. And we're now seeing companies, take one example, Gillette. They've looked at this market and said, what can a person afford to pay for a razor? Came up, I think it was 34 cents. So they designed a razor blade and everything with that price, and it's now being distributed out in India. And I think that's what fits very nicely into the Professor Moran's talk about the mainline businesses shifting. That's what's happening now. It's not only a question about corporate social responsibility, it's mainstreaming the business of these institutions, and that creates a whole supply chain of distributors and other things that are very important for those countries. But the competition for foreign direct investments among governments is also more intense than ever. And we all know that FDI in itself should not be a goal. And as Professor Moran points out, the record of FDI and growth are mixed. FDI combined with trade restrictions like domestic content rules or joint venture requirements can lead to inefficient and high-cost industries, and that's what we see very much at the micro level. There was also a time when FDI was considered a play to stabilize the role of the economy. I think the recent financial crisis, especially when you're talking about the bank systems, showed very clearly that in fact these foreign financial institutions was very much the transmitting link, bringing the Western financial crisis into the emerging markets, very much so in Eastern Europe, for example. I think the book correctly emphasizes the need to distinguish between various types of FDIs. In the natural resource extraction that Professor Moran talked about is very different from the other thing he talked about in manufacturing. And we, of course, as part of the World Bank, focus very much on the extractive industry transparency initiative, on the whole question of governance, and we see this day to day. I've actually come to the conclusion that especially if we do huge natural resource investments, it has to be done together with the World Bank, because if we don't get the two public and the private side to work together in countries like DRC, Mongolia, and Guinea, which are 3 countries that are going through a transformative type of investments in extractive industry, we can forget it. It's not going to be successful. We're also very active, as I see, with investments in the infrastructure. And we all know that inadequate infrastructure investments is an obstacle for economic growth in whether they're developed or developing countries. Because without, for example, electricity, factories can't run, and we've all seen that when we travel in Africa. The lack of roads, ports, storage facilities is the biggest obstacle for food security in sub-Saharan Africa. Actually, 40% of the food produced in Africa is perished on its way to the consumer because you don't have enough infrastructure to handle it. And the lack of transportation infrastructure actually often makes it cheaper for African countries to import food from North America than to move it from the surplus regions of their own continent. Agriculture employs 70% of sub-Saharan Africa's labor force, and addressing the poverty out there in the rural areas requires investment in agriculture, and that is, as I said, very much investment in infrastructure. Professor Moran's conclusion is that FDI in infrastructure correlates with high growth. And again, something that we see very clearly. As a matter of fact, when you build a road, you know that it's going to grow up small and medium-sized enterprises all around it. I think there is perhaps more controversy over the pros and cons of FDI in manufacturing than in infrastructure. The book offers compelling arguments that the benefits outweigh the disadvantages. In environments where companies can trade, manufacturing FDI leads to technology transfer, direct access to best practice for local industry. For example, it takes the example of the garment industry in Mauritius. Higher wages, I think that's an interesting one, showing very clearly that international companies pay more than the local companies. And actually that difference gets bigger the poorer the country. And I was also particularly interested in your finding that the benefits from FDI also fly home or comes home to the home country of the investee, of the multinational. For example, US multinational purchased about $6 trillion worth of goods and services from US-based suppliers in 2007. I think that, for me, was a very good paragraph. So I'm very much looking forward to your next work on services, because I think that is the next thing, IT services. I just saw a study yesterday by McKinsey who correlated the penetration of internet with the growth of the companies, and there was a very clear correlation. So I think that's something that we are looking at now, what we can do more of. So Professor Moran's recommendations boil down to a need for policymakers and developing institutions to focus on competitiveness. Governments must be strategic in the type of investments they want to attract, based on the country's competitive advantage and development objectives. The goal should be to constantly upgrade and diversify production and export base of the country. As you said, what exports matters. Richer countries tend to export not just more goods, but also high quality goods. Policymakers need to think twice about using fiscal incentives to attract FDIs. Research shown that the lost revenue can often be greater than the benefits of the investment as such. And perhaps more importantly, discretionary incentives are associated with increased incidents of corruption and bribery in the developing countries. General improvement in the business climate will help both domestic and foreign businesses. And last but not least, government should implement strong environmental and social protections. Companies around the world are, as I said, increasingly recognizing that strong E&S standards create value by improving brand, reducing risk, and I think it's very important here also in the new kind of paradigm that the NGOs can be very helpful actually in getting those standards implemented. We work, for example, with companies that have the wildlife forum that do certification for forest products. So far, I've discussed the recommendation for the perspective IFC as a policy advisor. We also, as I said, one of the largest global investors in developing countries with our 18 billion. And one of the important things that we try to do, and actually we're now also helping companies to do, and that was something that I would suggest for everybody that represent the private sector here, is to measure your impact. If you look at IFC, in our portfolio, we provide utilities to 212 million customers. We help educate our companies that we are involved in, help educate 1.4 million students. The company we're involved in paid 20 billion in government revenues, including 10 billion from infrastructure and 7.3 billion from oil, gas, mining, and chemicals. And our clients made 38 billion worth of domestic purchases. We're building a body of evidence that our individual projects are actually contributing to development. What this book does, it gives us the big picture that FDI has a significant positive effect on per capita growth in developing countries once the threshold of host educational levels has been crossed. Recent events in the MENA region illustrates why it's so important to approach development and attracting FDI in a holistic way, both for economic and political reasons. For example, education, and I think that was a point that you made, that you have to bring it all together. For example, education is not meeting the needs of the Arab youth. Only a third of employers are satisfied with the skills of new hires. And actually only a third or 2/3 of the students coming out think they're getting the education that will help them get a job. Last fall here in Washington, the former Tunisian Prime Minister came to us, and he was very concerned about the fact that he had 25% of the young university graduates were unemployed. And they were investing in education, but they were not getting the results. So he asked that we from the World Bank side would get involved, and obviously it was too late, but I think it's a very good illustration. But to meet this, we actually have been working on an education for employment initiative together with the Islamic Development Bank, and we mapped out exactly what can be done, and we now have teams in Tunisia trying to work on how can we better prepare the young people for what is needed for them to get a job. So concluding, I think IFC's program is very much in line with Professor Moran's recommendations. They challenge, or you challenge us to deepen and focus our current initiatives. I very much hope that government leaders around the world read this book. I certainly will have recommended to our staff at IFC to read it. I've used already some things from it. And I hope that we'll have a good discussion. And again, thank you for the invitation to comment on it, and congratulations on your book. Thank you very much.